All right, guys. How's everybody doing tonight? How are we all feeling? Good. Okay. So the purpose of this stream, right? So first of all, can everybody see my screen? All right, wonderful. Okay. So there's a reason for this stream, guys. The reason why we're doing this lesson is because, the market is going to always change, right? And because the market's always changing, that means we need to be able to adapt. We need to be able to see the environment around us, recognize the trend, and then act accordingly, okay? So doing the same strategy over and over and over again, is a recipe for disaster. If you continue to do the same strategy over and over and over again, what's going to happen is you're going to win some of the time and you're going to lose some of the time. Now, the whole point of easy money trading and the reason why we brought this group together is to show you guys that there's endless possibilities to make money in the market, whether it be up, down, or sideways, okay? So that being said, when the market presents you an opportunity like the last 2 days, if you haven't made at least 100% on options in the last 2 days, you're trading wrong, right? And that's just a fact. We need to be able to see what strategies are working and use them when they are working so that we can make money. Is everybody with me on that? All right, wonderful. So in order to do that, guys, you have to open your mind, right? You have to stop thinking what everybody tells you and the common conceptions of the stock market to be true, okay? You need to be emotionless. You need to take your emotions as is and become objective and start looking at things from a different perspective. And when you start to do that, you're going to start to realize that there are all these endless possibilities right in front of your face that you didn't realize this entire time. So how are we going to do this, right? Three-step process. First thing we're going to do is we're just going to go over the general mindset. How do you have to think about being a bear, right? Because that's not normal, right? That's not what we were taught. That's not how the stock market is meant to react to us. So we need to learn how to operate in this mindset. Once we do that, then we can start to look at some charts and some patterns, right, to see when it is time to be a bear and how to do that. And then the third part is execution, right? So now that you know what the mindset is and what the patterns look like, now you can execute to make the money. So we're going to do all of that right here in an hour. Okay? Let's make it roll. So in order to think like a bear, you got to understand some terminology, right? There's some things you got to know. So what is a bear market? If somebody says we're in a bear market, what are they talking about? A bear market is formed in a stock or commodity when the stock or commodity is in a downtrend, right, forming lower highs and lower lows on longer-term time frames. So we're not talking about like a 1-minute chart or a 3-minute chart. No, you're looking on dailies, on weeklies to establish something that's called a bear market, right, that the stock is on a downtrend. Wonderful. Resistance zone. So you hear me say this a lot if you're a member of this group. What does that mean? So if a stock is in a resistance zone, that's an area where there are more sellers of the stock than buyers. This is seen on a chart as big red candles that exit a consolidation zone and is usually accompanied by larger than average volume, right? Because when sellers sell the stock, they come in numbers, okay? There's always larger volume than the buying side. So keep an eye out for the large red volume candles. What's a put option? If we're telling you to buy a put, what is a put? So if you know what a call is, right, a call is a bet for a stock to go up. So we all know how that works. We pretty much, that's what you learned from the beginning. You bet on the stock to go up and you make money that way. But, over in the financial world, over at the banks, they literally made a way for them to make money on stuff going down as well because they love doing that. They love just making a bunch of things for people to make money on. So same way you can make money on a stock to go up, you can make money on a stock to go down, and that's called a put. So we bet on the stock to go down. All the same rules apply as a call option, except we want the stock to go down instead of up. There's another strategy that you can use instead of naked puts, which we call bear call spread, right? So this involves selling a call contract at a strike that you think the stock will not hit in the given time frame in order to collect premium from the option contract, right? So we all know this except this is a credit spread, so the potential returns are lower, but the security is higher, meaning that, you have a higher percentage of this trade working out, but it's going to be, you know, less percentage return. Now, there are some key phrases, okay, that you hear me say all the time that relate to a bear market and relate to the strategies you need to use in a bear market. And they are short the bounce and pop and drop. So everybody knows buy the dip, right? Stock goes down, you wait for a good entry price, you buy the dip, right? You buy it when it's cheap, and the stock goes back up. Short the bounce is the exact opposite, right? So as you know, stocks don't go up or down in a straight line, right? So stock comes up, then it comes down, it pulls back, it needs to establish support, and then it continues higher. Same thing on the opposite side. Stock needs to establish resistance to then come down lower. So nothing goes up or down in a straight line. During a sell-off, the stock needs to bounce or rise in price, right, to a point below the original sell-off point. That's the key point I want you guys to understand. The stock is not in an uptrend. It's not making higher highs and higher lows, right? No, it's making lower highs and lower lows, meaning that the price should rise to a point below the original point where it sold off from, not above. Keep that in mind. I don't care what time frame you're looking at, it applies all the same. Weekly, daily, minute, all the same. So this provides your sellers, right, your short sellers, the optimal opportunity to enter a short position, the put, right? In the same way, we tell you not to chase a call option when the stock is going up, correct? You don't buy the call option when the stock's going up, you buy the dip. Same thing with puts. You don't buy a put when the stock is crashing and you think it's just going to keep going lower. No, that's the exact opposite. What you're supposed to do is short the bounce. So you let it drop. You wait for the stock to come back up a little bit, and then once you've established the key resistance level, that's where you want to short it. So it's the exact opposite of buy the dip. So if you understand buy the dip, you should understand short the bounce, right? Exact opposite. So how about a pop and drop? Right? What's a pop and drop? So we've been playing this play multiple days in a row for hundreds of percent. So what does it mean? A post-earnings move, when the stock pops or rises rapidly in price during after-hours pre-market, right? You get a lot of people excited. Oh, great numbers. Oh, great news. Oh, this. I love the company. Whatever, right? Here goes the stock flying after hours pre-market. Looks like the reaction is bullish. But what happens? Stock then proceeds to drop significantly in the following trading sessions, right? So that is a great strategy because it's a trend reversal, meaning that you have the optimal opportunity to make the maximum returns on your options, which is what we're here for, to make money. So this strategy is great, especially when it's the prevalent strategy, meaning that if you've noticed, right, during this earnings season, Amazon, Apple, right, these stocks, great earnings, they go up, and then they come down. And everyone's like, why? Right? Why? Doesn't make any sense. Well, guess what? This is something that happens in the market, and when it does happen, we take advantage of it to make money. So, how about this? Fun fact. A put option is more expensive than a call option. What do I mean by that? If you go and you look, for example, at any stock, and you look at the at the money, call and put, they're going to be different prices. They're not the exact same. The call is cheaper and the put is more expensive. Why? Because the market makers know, right, what you think that the stock is meant to go up, stocks are going up, blah, 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 is wrong. It's the opposite. Stocks are more likely to go down than up, which is why you have to pay more premium to purchase a put instead of a call. Makes sense, right? How about this? A stock goes up 3 times longer, takes 3 times as long for a stock to go up than it does to go down. Weird, right? The gains that you make on a long call take you weeks, months, days to accumulate. The gains you make on puts take you minutes to accumulate. And why is that? Because bulls take the stairs and bears take the elevator. You've heard this a million times. So what does it mean? Bulls have to climb the stairs. It's long. It takes a while. You make small, steady gains. Bears, they hop out the window. They take the elevator. They're like, that's it. This is done. This is over. We're done. Everybody sell the stock. I hate the company. I no longer want to. I can't believe I invested in this. So that's when your stock is going to drop. And when it drops hard. So welcome to Bear World, right? In order to understand bear world, right, now that we have our terminology and our mindset, we can look at some patterns on a chart and see them. And that signals bearish. This is a head and shoulders, okay? You've heard it. So what does it mean? The stock makes a high, it comes down to this price point, a key price point, which we call the neckline, which has this gray line indicated here. It then goes to the head. It makes a new high above this previous one, finds resistance, comes back down to the original point, correct? Then tries to rally to go back to the new high, but cannot establish it. That is bearish, and when you see this sign, okay, there's a signal that the price is going to not only continue lower from here, but going to continue below this line. Okay, so if you see this on a chart, it's very simple. It looks like an M almost. If you see this M thing, looks like stock's going down. Pay attention. How about this? Everybody knows this. Double top, right? Stock comes up, stock comes down. Stock comes up to the point where it was before, it can't go any higher. So it comes back down again. What about a third top, right? Who says this thing can't come up a third time, a fourth time, a fifth time? Hit the same exact price and say, no thanks. Stock comes down. Breaks below the original price point, your neckline, correct? How about this? Rising wedge. What's a rising wedge? Stock sells off. Now it needs to bounce, correct? It's not going to go down in a straight line, down, 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 down. No. They're buyers. They need to, again, fill these orders. So what's it going to do? It's going to make a rising wedge. When you see this pattern, very likely the stock comes to the bottom of the wedge and what? Downtrend resistance. Okay? 3 patterns we need to learn. Head and shoulders, double, triple, quadruple, top, rising wedge. Now that you know that, we need to understand, why are we bearish right now on this market? We need to look at SPY. We need to look at the market and see what it is doing and what it has done in the past to establish a trend and see when the trend is changing. And in order to do that, all you can do is go to stockcharts.com, pull up SPX to look at this futures and see what is happening with the market over time. So let's do that, right? As you can see, I've pointed out these red candles that all have these bottoming wicks on them, correct? They have these little tails sticking out, meaning that there were buyers that when the sellers tried to push it down, they bought it back up, correct? Now, we have indicators to help us that show us, like RSI and MACD, what is actually going on with the price action and our moving averages, correct? To determine where a stock might bounce or whether this is, just some buyers to then come back down, right? So what if I showed you this? On this red candle, you have a bullish crossover about to happen on your MACD. So I put a green arrow, which again puts the stock going up, correct? Wonderful. How about this? Stock comes down again, preparing for a bullish crossover on the MACD. But there's a big sell-off, right? So the stock had to correct to then come back up. Wonderful. How about in March? Same thing. MACD comes all the way down, preparing for a bullish crossover. Wonderful. How about over here? Stock comes down. MACD already made the bullish crossover, so you knew for a fact this thing was going to skyrocket, right? All right, great. Now what's happening? We come into May. The volume is decreasing. Okay? You never want to see that when you're a bull. If the volume's going down, it's bad news. That means there's less buyers. Okay. How about this? I see a declining RSI that's now trying to peek its way above, right? But it hasn't really ever been declining in this whole particular time, except for here, and anything significant. And it was just overbought over there. So it's about time this thing comes down, right? What about this? MACD has already made a bearish crossover as of the end of April, meaning that it was time for the stock to come down. But did it come down a lot? Not too much. As a matter of fact, looks like this thing is preparing for a bullish crossover, correct? But has the MACD come down as far as over here, over there, over there, over there? Not even close. Where's your 50 moving average? Somewhere over here, right? All right, great. We have all these technical indicators to now show us that, hey, maybe this market isn't headed to the moon right this particular moment. I see a top that is formed here at 4,200. Not only that, I've taken the time to very quickly draw mini head and shoulders of the pattern that we just described over here. That is now forming on the daily chart of the SPX. That is bearish, correct? So if we've established that this is bearish, you have your left shoulder, your head, and your right shoulder. We would expect the stock to what? Come down and probably touch the 50 moving average, which is 402 on SPY. Considering you're trading right about now at 420, that's a 20-point drop you're talking about here on SPY. That's pretty big, right? So let's check this out, because there's way more money right now to be made on the put side than the call side. So if you're buying calls right now, you're wrong, right? Leaps? No. I don't care. 2 months, 3 months, 6 months, a year? No. Why? Because the market needs to come down first before it goes back up. So if you're buying calls, long calls at the top, that's the exact opposite of what we teach you to buy low and sell high. You want to buy calls here, you want to buy calls there, you want to buy calls there, and there, not here. No, absolutely not. Stock needs to come down. How about this? We have VIX, right? VIX is the market, what is it? Volatility, right? So VIX is going to show you the inverse of what the market is doing usually. When people get scared is when they sell. So this represents like a fear index, and as people get more scared, they, sell. So as the market goes down, VIX goes up. It's the opposite. So what you would want to see on VIX as the market comes down is a bullish pattern, right? So it's the opposite. So if the stock market is bearish, then the VIX is bullish. So how about this? We all know this pattern, right? Cup and handle. That's bullish. On the VIX, which is representing that there's more fear and more sellers hopping into the market, right? A low VIX would be something like down here, like 15, 14, 13, 12, 11, 10, 9. When you're in the 20s, that's high. That's scary, right? People are scared. Something's going on here. MACD, bullish. Bullish crossover happened in the middle of April. It's not too far extended, not even close. So guess what? VIX has a lot of room higher, which means this market has a lot of room lower, right? Easy money trading, bear market approach. When do I buy puts? As always, the objective is to sell high and buy low. So logically, you want to buy puts on a stock when the stock is at the highest price possible. We do not buy puts while the stock is selling off. That is the exact opposite of what you're supposed to do. Wait for the bounce. Short the bounce. Okay, we don't stock going down $3. Oh my God, it's going to go down to 0. Buy a put. No. Wait for stock to come back up $2.50, then short it. Okay? Here's the recommended strategies for when to buy puts. When the stock is in a daily resistance zone, it is showing weakness towards the bottom of that resistance zone, right? We're not just going to buy puts because it's in a red box. No, we're going to wait for it to break that box and come lower. That's what we're going to do. When the stock is in the prior to the daily demand zone and is showing weakness towards the bottom of the zone, oh my God, right? Everybody thought it was a demand zone. So here come all the buyers trying to push it back up. And then all of a sudden they realize, guess what? We can't get out of this box, and we're coming right back down. That's when it gets ugly, right? If you're a call holder and you, think charge point, the bottom of charge point is 20, you go ahead and you go buy calls on charge point at 20, and it comes down to 15, how do you feel? It wasn't the bottom, was it? Right? You tried to buy the dip, and what happened? You got screwed. So what do? You sell it for $15 because you realize it ain't going back up to 20, not anytime soon, and you want money now. So you put more sell pressure onto the market, which then makes the stock go down more. Hence, you get something like Skills. It goes from like $40 to 12.5 in a matter of a month. How? Because of this. All the sellers hopping in. Oh, I'm done, that's it. Oh, I'm done, that's it. Oh, I think this company sucks, so I'm done too. It all snowballs on each other. When do I sell my puts? Sell your puts when the stock is at the cheapest price possible for your maximum possible return. So how do we know what the cheapest price is? Simple. Look to your sell your put at the top of the most recent daily demand zone that you can find underneath the stock. That's our first price target. If you want to go lower, great, but that involves scaling out and looking for other demand zones, correct? So what strike expiration do I buy? As always, you build your trade plan around your preset price targets and pick a strike that will go from out of the money to in the money, like I've explained in previous streams, based on your projected move in your time frame. So if you think Tesla starts out this week at $700 and drops to $650, guess what? You could pick any put strike between $700 and above $650 expiring this week to make the highest possible return, correct? because it's not going to go below 650. So if you pick a 600 strike, you're going to lose. If you go and you pick a 710 strike, you're already in the money, and why would you pay that much for the premium when you can make way more returns on something like a 675 put? Doesn't make sense. So that, goes down to making a strategy before you trade. We're not just going to hop in stuff. We're going to go and we're going to analyze key points of support and resistance to enter our trades. Now you have the mental approach. Now you have the charts and the patterns, and now you have the plan to execute. So let's see how it's done, right? I'm going to go through a couple of examples, and we're just going to go and see how we would execute something like a put. Amazon, right? Everybody loves Amazon. Okay, well, how about this? The stock went to break out. It did earnings. It went to the freaking moon. It touched like 36 whatever, 36.30, 36.40, and then like a rock, right back down. So this is your pop and drop. But who knew that this was coming? Not many people, right? That came as a big surprise. But what if I showed you something like this? Stock is trying to make an all-time high, but the RSI can't even get over here, and it's starting to trend downwards. That's not good. What's going on over here? You had a bullish crossover on this 50 over the 200, which immediately then went back to cross back down to go what? Bearish. When the 50 crosses over the 200, we call that a death cross, meaning that the stock is ready to come down. So, not good. Amazon moving averages, RSI. How about MACD? Way up there. And there's your bearish crossover happening when? Right here. May. Beginning of May. This right here. So you should have known that Amazon was going to make another one of these. Of course. There's your sell volume. How do we execute? Here's Amazon on a shorter time frame. I want to buy puts. All right, great. You have a chance to short this thing at open because you know it's going down, right? So short it at open if you're really that risky, but that's not how we taught you to do this, right? So you have an entry here, but what happens? Stock comes down. So we don't buy the put. We let it go down, 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 down. The put gets more expensive. All right, great. Well, guess what? You know it should head lower, right, to where your previous demand zone over here. So what are we going to do? Stock's going to bounce, and once it does this little mini rise in price and you see that it's starting to fail, that's where we're going to enter the put. Okay, great. So then according to the strategy, the stock drops and we collect our gains, and then the first green candle that you see is your exit to usually get out, right, because you don't want to see a bullish reversal. So what I would say is, if you're day trading, you'd enter your put and you'd sell. You'd enter your put and you'd sell. It goes something like that. And here's another entry, and here's another entry, and here's another entry. Until when the stock, right, a previous place where it sold off from, it is now trying to come above. So I would stay in this put through this entire chop until here, right? This would be my exit. So if I hadn't exited somewhere at the bottom over here, right, just trying to collect the gains, my stop would now be set at the previous swing high of where this thing sold off from. So as soon as it starts to peak above, not good. Get out. Right? So that is an effective strategy to make money on a stock going down, isn't it? If you want to day trade it. What if you wanted to swing trade it? Very simple. Okay, you enter your put on this day when you see the crossover, and you just let it ride. Until where? At least the 50. Let it come down to 3,200. And then sell. Right? It's not really holding this prior demand zone. So even though you would draw a box here and call this demand, it's still trending lower, and that's because there's other indicators to show you that a demand zone might not hold. Amazon. Facebook. Same exact thing. Gas up after earnings. Everyone's like, wow, Facebook to the moon. Oh my God. Nope. Down. Whoa. Okay. Well, guess what? You have the RSI declining. You have it coming down to test the earnings gap. It went through the earnings gap, so that's even more bearish. That means it has to fill this at least, and then you can even come down there if you really want to. So you have to touch 315, and if not, you're going to 310. Right? That's a great put. Oh my God. And why is nobody shorting Facebook? I have no idea. People are telling me, oh, buy long calls on Facebook. Scalp the bounce on Facebook for calls, and make money on that. Hell no. What do you mean? Okay, look, this is like hundreds of percents right in front of your face. All you literally have to do is just go and take a second to look at these indicators and see that, oh my God, I have so much money to be made from 320 all the way down to 315 on a stock like Facebook, let alone 310. Come on, how are we gonna do it? Stock opens up, okay? It does a bounce. It gives you an opportunity to short it on this second candle, right? Because you saw this bounce, it gave you a red reaction, and then it tried to make a lower high, and then it went even lower. Enter. Okay, you don't enter. Fine, you missed it. Wonderful. Stock comes down, bounce. Always the bounce. It's always going to happen. And when you just see it, and it can't even get over here, guess what? They're probably going lower. So we're going to short it right there, and it's going to go down. And then we're going to collect our gains. And then you're going to see a green candle, and you're going to go, I'm out, and you're going to take your money. And then there's a red candle. And then all of a sudden you're going to go, I'm back in. There's your arrow. Get back in. Because why? Stock going lower. Sell it over here at the low, right? That's a safe place to make some money. Peaks even a little bit below, so you get some more. All right, you see a green candle that starts to come above this sell-off point. I'm now out. That's it. Done. All right, great. There's another entry because the stock comes down again. But once you see that it comes above this sell-off point right there, over here, you should be out of Facebook because it's probably going to go up. Solar Edge. All right, wonderful. This company, okay, reported earnings, it barely even popped. It didn't pop at all, actually. There was no such thing. This is just called a straight drop, right? Because what did this stock do? Like a rock. It gapped down and then it went even further. Okay, so to give you an idea of how much money you would have made on trading weekly options, knowing that this stock would have went down, right? If you go ahead and purchase a put at 240 and this thing goes down to about $210 over the course of a day, your options are about 500 to 1,000% return. And I'm not over exaggerating. I can go ahead and show you these contracts, like screenshots of like them actually producing this money, right? This is over the course of a day. Solar Edge, we're going to go ahead and see that the stock is coming down in pre-market after establishing a high, and it gives you an opportunity to short it open. You don't short it open, absolutely wonderful. It gives you a green candle, which shows you a bounce, which gives you an opportunity to what? Short. Great. Stock goes down over there, collect your gains. By just shorting here at 235 and collecting profits down here at 220 bucks, $15 over the course of 30 minutes on a stock like Solar Edge will make you 500% on weekly option puts. How about this? You get another bounce, which comes even higher. Another perfect opportunity to what? Not buy calls. Wrong. Short. Because you have not even made yourself anywhere close to your previous sell-off point here, and you're using this sell-off point as your anchor. So if you want to buy puts, your next exit point would be here to set your stop loss to establish a trend. If not, down. So you just wait. Wait for it to happen. It's going to happen. Down. Collect gains. Bounce, drop. Bounce, drop. All day long. Right? Who cares what the market's doing on May 4th? Right? Solar Edge. So, it's like right here, guys. Twitter. You see your big green candle, oh my God, Twitter to the moon, oh my God, Cathie Wood buying all these shares, oh my God, 2 million shares purchased of Twitter, and yet it continues to go down. Why? Look, it's right here. Here's on your daily chart, making lower highs and lower lows, going down to 200 MA. Wonderful. Perfect opportunity for what? Not calls, puts. Thing goes in, open, gives you a bounce. Oh, wonderful. Short it. You don't? Okay. You get 1, 2, 3 more entries on Twitter before it comes back up on you. So, getting $1.50 or $2 on a stock like Twitter, you're talking about a 60-cent option going to like $2. What's wrong with that? Nothing. It's amazing. And let me tell you, that money to be made on calls will take you days, weeks, right? So, wouldn't you want to do that in 30 minutes? Ring Central. I posted this trade for the group. All right? To give you an idea of this, I alerted the 305 weekly put yesterday for a cost average of $4 per contract. This contract today at $260 is now worth $4,000 a contract, meaning 1,000% trade by holding it just one night. Wow. Okay. How about during the day, if you just day traded it, you could have made up to 300% just over the course of the day. I sold at 100% because I want to lock in my gains and be secure. But how about 300%? Huh. I wonder how long that would take you on a call. Okay. Ring Central. How do we know it's going to go down? Declining RSI, does the pop, gives you the drop signal. There's your bearish crossover on your MACD. Absolutely wonderful. Short. PayPal, right? This is today, okay? Everybody that was here in the group, Zach says short PayPal, short PayPal. Well, Zach shorted PayPal over here, right? I shorted this exact bounce, knowing that the stock was not going to be able to establish a bullish trend above this zone because it had come down from its previous high in pre-market. So that was showing me the initial signs of a pop-in drop. And seeing the market this morning, correct, that the market, opened lower and started to head lower at open, is the signal that pop and drop is a very high possibility here on PayPal, especially when tech is weak. If you look, tech is being sold off right now. All of these growth names are not in favor. Nobody wants to buy them, so they want to short them. So we're going to short them. Okay, we're following the banks to make money. So as the thing bounces, we place our put order right about here. We set our stop loss here, and we start to establish a trend. As this thing comes down, we do not collect profits this entire time as this thing drops. We do not sell on these three green candles because it doesn't establish a previous high. So as everybody's freaking out and selling their puts here for 50%, 60%, they're a bunch of idiots. We're going to continue to hold our puts. Thing drops even more. We're selling over here for 150% and calling it a day, right? Why? Because the stock is now dropped a significant amount. It's now starting to form some green candles, and 150% should be good enough for anybody. So get out. That was my trade. All right, great. You missed it. We had all day long to establish this rising wedge, which is a bearish pattern, which we went over in the beginning of the stream. So if you see the rising wedge, all you have to do is take a couple seconds on a 1-minute chart to draw these lines and establish your rising wedge. When the stock gets to the top, that's an excellent opportunity to short, correct? So where do we alert a second round of puts? Right about here at, this is Pacific time, so if you do it in Eastern time, that's 11:30 Eastern time when we started alerting puts to our members here at 2:54. Wonderful. All right. Everybody thinks PayPal's going up, 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 up. No, you've hit the top of your rising wedge, and your target is now to break the wedge as we've shown in the previous slides. So as the stock chops around and comes to the bottom of the wedge, you've now confirmed your entry. It's looking beautiful, and it should bounce and crack. So anybody that told you to buy calls from here to here made probably about 30% to 40% on weekly options. Wonderful. Good for you. I hope that does well for you in your account. How about this? You buy puts over here, and by the time it hits 11:30, you've made 100% from there to there. Stock rallies at the end of the day, sure. All right, wonderful. You could have made probably 10, 15% on calls from there to there, but yet again, an hour, you made 10%. 2 hours, you made 100. What sounds better? 10 times your money? I think so. So to leave you guys and end this presentation, I want to go off with this. Square, running to the moon after hours. Oh my God, pop. Woo, Square. Great earnings, Bitcoin, great company. Everybody loves Square, Cash App. Whoa, hold on a second. What do we got here? Declining RSI, underneath 50 moving average, big red candle, bearish crossover on MACD, not anywhere near the bottom, big increasing sell volume. Bearish. Watch for a pop and drop tomorrow, guys. Square is a perfect opportunity to short. And that's what I got for you guys tonight. Welcome to Bear Trading 101. Any questions? I'm so sick and tired of sitting in this group and watching, right? This is easy money trading. It's not easy money trading if you sit here and lose money on these last 2 days. If you're sitting here making 10%, 30%, this is not easy money trading. If you are quiet, losing money on these types of days, you need to stop. You need to reevaluate. You need to go in there, and you need to make a new strategy, a strategy that works, right? So guess what? There's times to be a bull, and there's times to be a bear. And right now is the time to be a bear, and you need to act. So what does that mean? Go home tonight, find some charts, find some bearish plays, target some prices, and develop a strategy. That's all you got to do, and the money will come. It's that simple. Any questions? Like seriously, guys. Like, floor is open. Yeah. Okay, that's a great question. So, scalping, you're targeting smaller returns, right? We're not going for the moon on a scalp. You're in it for a short period of time, so you want a smaller price target. Okay, if that's true, and I told you that calls take 3 times as long to make money as puts, is scalping calls ever really a good option? Not really when you think about it. And everybody does what? Scalps calls, right? So, you're scalping calls and you're not making a lot of money. That doesn't surprise me. All right, well, how? Yeah, of course. Right. So that's right, that's true, but what the point that we were trying to make earlier is that, again, it takes stocks a lot longer to go up than it does for them to go down, meaning that the price action is not the same, and that's why the puts appreciate much faster than the calls. Yeah, go ahead, please. Yes, exactly. Exactly. Thank you, Dan. I appreciate that. And then, so if you follow that thought process all the way through, then that would mean that out of the money calls as a scalp option is very, very, very unlikely, because you're asking the stock to go from a price that it's already at to a price that it's not and continue. That's not as likely as going for an out of the money put, where a stock can drop past that price level and continue to drop. That's much more likely, correct? I mean, there are times to play calls, correct? When the market is making a bottom and it presents you an opportunity to get stuff for cheap, do you want to buy those, what we call out of the money call leap options, right? Where people make a lot of money on buying Fubo at $19 and watching it go to 40, right? That's great. That's good for you. And you have to buy a leap option with months of time on it in order to achieve that type of return. They're still good. They're not. There's nothing wrong with leaps, but there's a time to purchase them, right? And is now the time to purchase any call leap options? No. Uh-huh. No, please. I appreciate the input. Go ahead. The idea is to the idea is to do what everybody least expects, because if you're just following the herd, what are you going to do? Get crushed on a day like today, right? And what I don't understand is why people are starting to buy calls on a day like today when so much more money is being made on the put side and the market makes a giant green candle and it's up back up to 419. How does that make any sense? It shouldn't. And the reason why it does is because of all of this. I mean, we had Isaac Beasting over here take, PayPal and with me in Easy Money Live today and generate 150% in 30 minutes. Like, you guys, if you just put any sort of capital into that, you could be making, yearly salaries here. We're not talking pennies. Okay, if there's one point I want to get across with all this is that, yes, being a bear is great. Making money as a bear is great. If you are a bear on the wrong days, like last month, what happens to you? Bye-bye. See you later. So guess what? We adapt our strategies, right? We're not going to play puts if the market all of a sudden starts to look like it's headed to the moon, right? That's a bad idea. That's a good way to lose money. So I highlighted this as a way to make money now while it's working, which I think should continue for the month of May. So if that's so, during the month of May, we should be looking for puts, not calls. So again, any naked option, right? So if you just buy a put, the max risk that you take on is losing the entire option, correct? The worst that can happen to you is that your option goes worthless. Um, you know, if you go ahead and you do a spread or you do some sort of, bear call spread or a bullish put spread, right? Like you could do, there's a couple things you could do to be bearish, but like if you do that, that again, like there's different risk reward profiles. You have to study the strategy you want to use. Yeah, of course. Anybody else? Any other questions? Uh, that's JC. Yeah. Mm. Right, that's exactly right, Isaac. So, as people set their stop losses as the owners of the stock or call owners, right, and they set their stop losses at certain price levels, as those price levels get violated, the selling starts to accelerate as people exit their positions. So, you know what a short squeeze is, right? So when the shorts have to cover and the stock goes up rapidly, it's the same thing on the opposite side. If everybody sets a bunch of stop losses and they get violated on the put side, then the thing is going to tank. It's okay, man. It's okay. I mean, I've covered pretty much everything I wanted to cover tonight. So the last thing I want to leave you guys with is like use this opportunity while it's here. All right? Take advantage and do what needs to be done today to make money today because that's why we're here. Right? So that means go tonight and look at some charts and try and use this whole short the bounce, pop and drop, buying puts. Right? Again, if the market is bullish, we're not going to run to buy puts, right? We need to react to the market. So guess what? If market starts heading towards, 41.25, that's not good to buy puts, is it? So keep your eyes open and be ready to adapt, fellas. Like these things give. Adapt or die. That's how we live. And that's how we do it. All right, boys. Have a good night. Send me some Bears plays in the group, guys. I need you guys' help. I need you guys' input. All right, I'm here, guys. So let's make a roll, right? Let's do it. I'll be back in a little bit.